Well, good morning, everybody. My name is Kristie Elmquist, and I'm the FDIC's Dallas Regional Director. I'm honored to moderate our first panel this morning because I have the opportunity and privilege to introduce you to 4 very experienced bankers and 1 distinguished educator and researcher. I've had a great time in the last couple of weeks getting an opportunity to talk to them about a variety of community bank issues. And I think you're going to find their comments this morning interesting and informative. And I hope that you will see their passion for community bank that I have seen from them. So please let me introduce our panel. To my immediate left is Dave Hanrahan, Sr. He's the president and CEO of Capital Bank of New Jersey in Vineland, New Jersey. Next to Dave is Rebeca Romero, Rainey, who is the chairman of the board and chief executive officer of Centinel Bank of Taos in Taos, New Mexico. Next to Rebeca is Bruce J., president and chief executive officer of Valley Republic Bank in Bakersfield, California. Next to Bruce is Alden McDonald, Jr., president and CEO of Liberty Bank and Trust in New Orleans, Louisiana. And finally, Dr. Scott Hein, the Robert C. Brown Chair of Finance at Texas Tech University and faculty at 3 different graduate school of bankings. First, the Graduate School of Banking in Colorado, the Southwest Graduate School of Banking at SMU, and the Texas Tech University School of Banking. So please join me in welcoming our panel. This morning, Dave, Rebeca, Bruce, and Alden will share insights about their bank's business model, strategies they have used to overcome various challenges, and practices they have implemented to manage key risks. And Dr. Hein, Scott, will provide an academic perspective to each of our discussion topics. So let's get started by having our bank panelists provide an overview of their institution's business model to provide a context for this morning's discussion. Dave, why don't we get started?
Good morning, everybody. Capital Bank. Good morning, everybody. Capital Bank of New Jersey was chartered in 2007. We're located in southern New Jersey, southeast of Philadelphia, Pennsylvania. Today we're about $380 million in size with 4 locations. We follow a classic community banking model, bringing in, as my CFO likes to say, local, loyal, low-cost deposits and lending them back out to small and medium-sized businesses in our immediate area. I'm very proud of our growth and success and proud of my team. One thing I could not have predicted when we opened for business in 2007 was the coming crisis, nor could I have predicted how good it would be for us. As counterintuitive as it may sound, 2008 and 9 and 10 was a great time to be a brand new, well-capitalized bank without any bad loans in its portfolio, because we hadn't been around in time to make any yet, lending money at a time when many of our peers wouldn't or couldn't. And that crisis gave our growth a huge shot in the arm. We've also been the beneficiary of a lot of merger and acquisition consolidation in our market, starting with the 90-year-old community bank in our market that was sold to a regional right before we opened. Our little parochial Vineland didn't like that so much, and we benefited from that change and have continued to benefit from similar changes over the last 9 years.
Good morning. Centinel Bank, Taos, New Mexico, located in the northern part of the state, high mountain desert up at about 7,500 feet. I say this because it's important. Taos is a tourism-driven market, and so hopefully my comments today engage you enough that you want to come visit us in Taos. Chamber of Commerce speak out of the way. The bank was founded in 1969 by my grandfather. I'm 3rd generation to run the bank in our geographic footprint of Taos County. The town of Taos is about 7,000 people, the county itself about 35,000. Very rural, very spread out, and our single market industry is tourism. The largest employer is government. We run about a 9% unemployment rate. Local economy is very challenged. We have a main office and 2 drive-through facilities. We're a one bank holding company, sub S, and we have 6 owners. very much relationship-based organization, and over the bank's 47 years of history, we've had the opportunity to work with multiple generations of businesses, work with the local economy with the incredible spirit of entrepreneurship. We have more artists and nonprofits in Taos than I think anywhere in the nation, which makes running a community bank all the more interesting, and need for creative approach to dealing with that type of population. Very much relationship-based. We have averaged 5% growth year after year. Slow and steady wins the race, as I like to say.
Thank you. Bruce.
Well, good morning. I think I'm on the panel today because we're the poster child for de novo bank in this economy. We're certainly the newest bank in the Western region. We opened in February of 2009. And to my knowledge, probably one of the newest 4 or 5 banks in the United States since the recession. So it's been a very interesting journey for us. Been very, very successful, and I'm honored to be here today. We're located in Bakersfield, California, and for many of you on the East Coast, we're a different part of California than what you've probably read in the press. We're kind of the Texas of California. We're located about 100 miles north of Los Angeles at the south end of the San Joaquin Valley. Our county is the #1 oil-producing county in the United States. If our county was a state, it would be the 3rd largest producer in the nation. And we're the 3rd largest agricultural producing county in the United States. So oil and ag are very important economic drivers to us. Appreciate Marty's comments about reducing the de novo period to 3 years. 2 months ago, we graduated from the 7-year. So timing is everything. So we are a C Corp. We organized the bank initially with $25 million in capital, and we're about $500 million in assets today. Our current run rate on ROE is around 9 to 9.5%. We have about 300 local shareholders, all very distributed. Largest shareholders, we have a couple that I think have about 6%, but other than that, very traditional, very vanilla community bank. We just opened our 3rd branch about a month ago, so if you think of $450 million in deposits spread among 2 branches, very low-cost overhead structure. Our total overhead is about 100 basis points lower than our peer group. And when we opened in 2009 with interest rates the way they were and margins as compressed as they were, we knew we had to be very efficient to be competitive. We're very traditional, very vanilla. Our focus is CRE, C&I, and ag. And our average account balance is about $150,000, which is kind of unusual. And probably one of the most interesting statistics about our bank, in 7 years, we've never had a single 30-day payment delinquency or a non-performing asset in the history of our bank. So.
Thank you, Bruce. Alden.
Well,
that's a good thing.
That's a tough act to follow. My name is Alden McDonald, President and CEO of Liberty Bank in New Orleans. That's where we're headquartered. Our bank is presently in 8 states. We have approximately 23 branches, 30-plus ATMs, and we're celebrating our 44th year in community banking. In 1972, a group of citizens in the New Orleans area came together to develop a bank to service the community that was somewhat ignored by the larger banks in mainstream banking. Today, we still follow that same business model. Our customer base is primarily low and moderate income, and also with a focus on the African American community in all 8 states that we're located in today. We have high volume and low balance, so the business model sort of created an incentive for us to find different ways to run a community bank because of our high overhead, not like Bruce's bank. Our loan focus, for the most part, has been 1/3 consumer, 1/3 commercial lending, and 1/3 mortgage lending. And we found that to be a pretty good balance that really carried us through many of the different business cycles that we experience in our economy. Today we have less than 100 shareholders, and over the last 10 years, our growth has been primarily through acquisition of small community banks, primarily outside of our community. We learned back in 2005 when we experienced Katrina that diversification was very important. And because we had already began looking outside of our community for expansion, we took on the expansion mode of acquisitions in various communities. Also, because of changes in banking, changes in opportunity for us to continue to survive with the type of customer base, we also looked outside of the normal banking cycle, and we invested in a leasing company. 5 small banks got together and formed a leasing company that today is still in existence. It's about 17 years old, and it provides a pretty good source of revenue for the bank. I think throughout the morning you're going to find that community banks must change its business model or the way that they perform in different types of economies.
Thank you, Alden. Scott, you do a lot of research in community banking. You do a lot of teaching for community bankers. Will you reflect on the community bank model from that perspective as well?
Sure. I think the reason that I've been invited is I'm a friend of community banks, and that friendship, I think, has been developed primarily through my association to the bank schools, with the bank schools that Kristie's mentioned. Banks get money in, get money out, get money back. So they all do that same thing. But I've noticed in teaching at these bank schools that most of the attendees come from places we'd call community banks then, that are different. They have, as just characterized here, very different takes on how they get money in, how they get money out, and how they get it back. They have a unique approach, and I was just thinking, one thing I struggle with as an academician is, what is a community bank? And I would applaud what the FDIC has done research-wise in identifying community banks, and they go through and look at each bank and study in depth aspects of the business model. Academicians for many years have done the easy thing and said asset size is going to determine a community bank. If it's below $1 billion, or as Marty was saying, it might be now something as below $10 billion might fall into a community bank profile. We have community banks then that do things differently, and it's hard to identify what's unique about them. But I was just thinking, community, why do we call it community bank? I think the answer is community says we look beyond self. There's something beyond that is important. And I think that is what makes us focused in a unique way on our community, beyond just ourself. The big banks get money in, get money out, and try to get it back as well. But I think community banks do it in a different fashion. Academicians then talk about focused on relationship banking, and we try to translate that, and well, that's in finance parlance. We say you use soft information, and trying to quantify and measure that is very difficult for academicians to do, but I think that is broadly capturing the uniqueness of what community banks do. I really am a friend of community banks for the primary reason that Marty said. They're an important part of our financial system, and they are a primary source of economic growth that I think this country thrives on. So I appreciate this opportunity, and I applaud the FDIC for hosting this conference. Community banks are something that we need to continue to develop and foster going forward.
Thank you. So thanks everyone for providing some background information. I think now that we have some context, let's talk a little bit about some of the key marketplace changes or trends your bank has faced and the actions or strategies you and your team implemented to ensure success. So let's try to limit it to one or two key marketplace trends so that each person will have an opportunity to share comments. So Dave, will you lead us off again?
I'd be happy to lead us off. I first have to say that Bruce claims that his bank has never had a 30-day past due account. I can assure you that I think Capital Bank of New Jersey was 31 days old when it had its first 30-day past due account. One of the biggest challenges I feel like we've faced over the last 9 years is the low, flat yield environment. Ironically, the last and the only time I was in this room prior to today was in 2010 when I attended the Interest Rate Risk Symposium that the FDIC held here. And in preparation for my comments today, I went onto the FDIC's website, which is a treasure trove of information, by the way, and I managed to find not only the agenda for that day, but a transcript of the event, the PowerPoint slides, et cetera. And clearly, we were all, bankers and regulators alike, we were all worried about interest rates snapping back and not going out too long on our asset durations, et cetera. Boy, how wrong we were. It's humbled me over the last 9 years that whenever I try and predict rates, I'm usually wrong, so I try not to do that. The best thing I believe I can do is really lean into my interest rate risk models, testing all different scenarios. And I got to tell you, the one that I fear the most right now is that rates stay right where they are. That's worse for me than a 200 basis point shock or a 400 basis point ramp or any of the other scenarios that we run. Therefore, over the last 9 years, as we've dealt with a ever-increasing margin, as Chairman Grunberg referenced earlier in his comments, we have continued to emphasize growth, but we've had to watch overhead like a hawk. We have 4 branches. However, we haven't opened one since 2010. The last 5+ years, we've leveraged the branches that we have, and we need to continue to do that, growing but managing the overhead. That's the only way that we're going to be able to continue to put money on the bottom line. The amount of deposits I can get out of any one of my branches is finite, and I think at some point we're going to begin to use more non-core funding to augment our balance sheet. And I know that there's some history between banks and their use of broker deposits and what regulators think of that. I think to a point, it's a nice alternative funding source to use to continue to add to the growth of our bank without increasing needlessly the overhead that we have. So the interest rate risk and this environment has been the biggest challenge that we've faced for the last 9 years, and I think it will continue to be that way as far as my eye can see.
Thank you, Dave. Rebecca?
So for us, the marketplace trend that really isn't anything new that we've always dealt with in the history of the organization is the lack of market diversity and our local economic challenges. The strategy for us has been key is long-term relationships. And when I say relationships, it's interesting to try and define that. And I appreciate Scott's comments around the academia approach. For us, it goes beyond the financial information. It goes to knowing the individual and having that inside knowledge of whether it's a service that they're providing, a product that they're providing, how they are surviving today, what's driven them in the past, but more importantly, how they will be able to thrive in the future. A couple of specific examples for you. As I mentioned, we have a lot of creative people in Taos that has led to some creative and alternative approaches to building. Literally, we have a world-renowned architect who is building homes out of used tires and beer cans. We started lending on these homes about 30 years ago, and we had some interesting conversations. I remember as I came into the bank trying to explain to examiners that yes, this is a sustainable home and it makes sense and there is resale value and we've got this figured out. We had it figured out because we were on the ground and we understood what was going on. We also understood the market need and desire within our community for this type of product. And so over the years, not only have we been able to help this borrower survive and thrive and create quite a development of these homes, we've also gotten them accepted on the secondary market, and we've created an environment where this product can thrive because the financing has been provided and somebody was willing to take that risk. We see that as well in a market driven by tourism and a lot of second homes where discretionary income kind of fell out over the last several years. Those contractors needed something to do. We've had a mine reclamation project. We've had some infrastructure development going on up at the wonderful Taos Ski Valley. Significant $35 million project up there. Not a single contractor in Taos could tackle that project, but they could do it as a collective. We were able to come to the table knowing their skill sets, you know, whether it was the trenchers not being able to do all 10 miles of the project, but 3 of them being able to split it up, but they couldn't get the bonding to get that project done for the scale of the contractor they were working for. We provided the letters of credit to say, yes, not only do we know they have the financial capacity to do this, they have the skills and can get it done within the time frame that they've been allocated. Again, because of our knowledge of the borrower and their ability to perform. Put that all together, today those folks have some significant capital infused within their business. They're back on their feet and the project is done by local individuals. And that really, I think, is this key to our market strategy, is being resilient and creative enough in the good times and the bad to be able to respond to those unique needs within our community.
Thank you, Rebecca. Bruce.
I'd ask you to go back to 2009 and 10 and remember some regulatory examinations that you had. Anybody have a good experience during that period of time? In our situation, excuse me, we just opened the bank. We had no peers. We were a safe haven, so we attracted a lot of core deposits very quickly. And in our first year, we exceeded our business plan in terms of core deposit growth by about 400%. So at the end of the first year, we were blessed with our first regulatory examination. I had 16 staff members. We had 20 examiners on site for 6 weeks. And they didn't know what to do with us. The regulatory world was changing. A lot of pressure coming out of Washington on regulators to tighten down the examination process, et cetera. And it got a little unruly for a while. I'll be very candid about that. The way we dealt with that is we were very intentional about developing a relationship with particularly the FDIC. And I will say the regional director in the Western region was receptive. I cornered him at a conference and I said, we really need to talk. And he was courteous enough to grant a face-to-face meeting with the chairman and I a couple weeks later. And so we went up and sat down and just eyeball to eyeball shared what was going on in our marketplace, what was happening in our business, and worked through it. And since that point in time, I've made a conscious effort at least twice a year, either myself or the chairman and myself, we drive to San Francisco and have about a 2-hour meeting with the regulators. And that has been one of the most positive experiences that I've had in our 7-year history, and I would highly, highly encourage you to develop a close working partnership with your regulators. Secondly, I think one of the advantages we had, again, when we opened, our size allowed us to be very, very agile. And most of the larger banks and tenured banks were dealing with asset quality issues. We were able to figure out where the landmines were and where the opportunities were and capitalize on those in a very quick fashion. It wasn't a smooth road. I'd hired a chief credit officer who was very well known in the community. He was old school, 65 years old. He'd been a chief credit officer for a long, long time. He was old school. He was a shake your hand, collateral-based lender. Well, that didn't work in 2011, 12, and 13. And after 2 years, it became obvious I needed to make a change. And you got to recognize the environment, anticipate what's coming, and adjust your organization accordingly. I think the value of community banking with our size, we can make those changes quickly and adapt to the environment.
Thank you, Bruce. Alden.
I will share with you two examples of how we had to overcome changes and trends in the marketplace in banking. As I mentioned earlier, that our bank was basically servicing both the consumer community and the small business community in the banking space that the larger and the regional banks did not want as business customers. So we had a pretty good niche in our beginnings of who we were servicing, and not too much competition. And then some of the rules of the game changed, and a lot of the banks had to begin showing that they were lending to all parts of the community. The Community Reinvestment Act came into play. And at that particular time, our target market became the target market for the large and regional banks. And what they did, they came into the market space that we had and offered terms and conditions that made it very, very competitive for us. They reduced interest rates down below of what would be competitive for us. They gave better terms and conditions for the better credits on our books, which left us with a void in dollars to lend, a void in our interest rate spread, and we had to really huddle and come together really quickly to offset this drain from our earnings assets on our balance sheet. And becoming creative, we again looked at the space that the larger banks did not want to participate in the banking industry. So we began looking at and became very creative and put together a school tuition program for the Catholic and private schools, where we convinced the schools that it would be best for them to get out of the collection business of collecting tuition on a monthly basis and have everyone to pay up front. So automatically we created some 300 to 400 new customers, as well as the commercial side of the school business. That was just one piece. The second piece is at that particular time, the larger banks were not interested in mortgage lending. So we became robust in mortgage lending in our community and became the #1 FHA VA lender in our community in order to put some new things in place. The second story I'd like to share with you, I mentioned earlier that Katrina hit in our community in 2005. Our bank lost 80% of our customer base, had to evacuate from the community, and most of those individuals did not even begin coming back until 1 year afterwards. our institution, we lost all of our customers, all of our employees as well, and all of our records. So we literally had to find a way to restart the bank in a very short period of time and to begin building our institution again. And the moral of that story is that we had to find a way to change, because after the number of years that we've been in business, all of a sudden you lose all of your customers. So we had to become very creative again, which then put us on the road to internet banking, and a lot of our customers really jumpstart the technology side of banking, where most people were a little bit reluctant back in 2005. That particular event drove us to two things. Number one, I hired 15 young people to come work at the bank, because at that particular time, I figured I had to change my customer base as well. And I want you to think about that, because most bankers, we just go along with the customer base we have and nurture ourselves on that. But it taught me and it showed me that I had to begin thinking out of the box. So we hired 15 young bankers and literally put them in position of authority within the bank, because I had to create a new customer base, which then put me into the millennials. And then I had to begin thinking differently. So now we think technology banking. And the technology banking has driven us to the point now where we have been in the process over the last 3.5 years of creating a virtual bank. In the virtual banking business for us, keeping in mind our business model, we have to now compete with the non-banks that are coming into the community and offering services to the consumer, as well as small business. So we've been about 3.5 years now ahead of working in what we call the virtual bank space. Last year, we kicked off account opening on the internet, which we've been very, very careful about over the last 5 years of thinking about it. We also have online lending, and we did a 3-year pilot project on that, and our losses came out to be less than our credit card losses. So I would like to encourage you to sort of think out of the box when you have all of these changes that are taking place in the banking community. And I guess if you've been in banking as long as I have, we've been through a lot of ups and downs. And the key to our success over the years that we've been in business is our ability to change when we see change.
Thank you, Alden. Scott, will you please share some insights from an academic perspective on this topic?
Well, I would just call your attention to the stories that we just heard. One theme I heard, we were all challenged in many different ways. The economy challenged us. We were in a different environment that was more creative. We had to deal with hurricanes, but all of us, all of the stories that were relayed are examples of resilience in community banks then. I think this speaks to the uniqueness of community banks in a lot of ways. They are adaptable and do adopt creative responses to very difficult challenges that face them. As a former Federal Reserve economist, I can't pass on the opportunity to talk about the economic challenge then. I would say I've been a little disappointed myself in community bankers in not voicing more opposition to the low interest rate policy that we've had thrust on us for many years. I don't think this is the way that we should be trying to strengthen our economy. We do have significant economic challenges facing the economy, but low interest rates, I think, has been proven not to be successful in changing that tide. And I think we should move more quickly to normalize interest rates. I agree with Dave that keeping interest rates where they are doesn't make sense to me. We should understand that our depositors are being harmed in a real sense when we can't pay them, even to reward the damage done from inflation. So again, I think community banks adapt to challenges. We have made it through this environment, and hopefully it will be changing going forward, and we will have more economic wind behind us than economic wind in our face. But I'm still encouraged that community banks have risen to these challenges in a variety of ways.
Thank you. So now that we've looked back in time, let's switch gears and talk a little bit about the strategies you are putting in place now to prepare for the changes that you see in your marketplace that are just beginning to take hold or that you foresee emerging. So Dave, want to get us started again?
Be happy to. I realized when I gave my introduction on Capital Bank, I failed to tell you about our ownership structure, and that's going to play into what I say next. We are privately held. We're a non-SEC registrant, and we have about 450 stockholders, almost all of whom are local to our communities. I'm sure a lot like most of you in the crowd. The chairman made reference earlier to the FDIC study showing that banks are able to achieve most of their economies of scale when they reach $200 to $300 million, and that is exactly the case with us. We've managed to post a double-digit ROE the last couple of years, and I feel like we've now hit our stride in our ability to generate returns for stockholders. That said, the lack of liquidity in our stock is an issue for our stockholders. When we did our local capital raise, we told everybody, this is a long-term investment. Don't plan on getting your money back anytime soon. And they listened to that and believed that, but life happens. Stockholders die, they get divorced, they got to put their kids through college, and increasingly as time has gone on, they've needed to liquefy their stock, and there hasn't been a good means for our stockholders to do that. So last year, we conducted our first ever stock repurchase offer with our stockholder base, and in about 5 weeks' time, we bought back approximately 2.5% of our stock. It was elegant in that it provided a relief valve for those stockholders who needed or wanted liquidity, along with an ability to leverage my capital a little better. And I'll harken back to the comments I made in response to Kristie's first question. As we are challenged with an increasingly shrinking margin, one way for me to drive earnings per share and ROE is to leverage my capital and shrink the number of shares I have outstanding. And this voluntary program was a very good way for me to give certain stockholders what they wanted and making it better for everybody else who stayed in. And I hope the 2015 stock repurchase program is just the beginning of what we can continue to do over time to continue that liquidity option and leverage our capital prudently.
Thank you. Rebecca.
Alden touched on this a bit, but I think as we as a smaller rural community bank continue to think about our delivery channels in the future, one of the things we're really honing on is the ability to leverage technology. You can never be all things to all people, but how can, from a service perspective, can you offer a variety of options? And for us, that point of service experience in the lobby has to be as perfect as the online experience with our customers. And for me, a key piece of that has been our employee knowledge. You know, it dawned on me as we were launching mobile banking, not all my employees had smartphones or would think of the ability to service customers. We got iPads for every employee, and as we launched this product, we had a test phase where every employee used it themselves. It seems very basic, but from a service experience, as we think about changing delivery channels and we think about informing our customer base, we as the employees have to be able to use this technology and really appreciate it to be able to sell it. So for us, that's been a key piece with technology. I think another key piece, again, in rural areas, who are our future customers going to be? You know, whether it's the next generation of businesses, whether it's the new entrepreneurs, what brings them into Centinel Bank? What encourages them to think about us as a resource? And so telling our story has become a lot more important as we think about, again, these online channels, whether it's through social media, whether it's through the school systems, all things that we've always done, but getting more creative about what those channels are and how we tell that story. So that we are not only, in my opinion, branding Centinel Bank and what we can offer, but a key point in that too, especially with some of the younger students, for me is getting them to think about the distinction of financial services. And whether it's in Taos, New Mexico that they're opening their small business or anywhere else that they're seeking out a community bank and they understand those differences. And so that's been an important piece. And through those, you know, some of the specific things that we're doing is not just telling that story, but making it hands-on. You know, we all offer various financial literacy programs. I'm going into the classroom and talking about some of these things, as do all of our employees. We do a learn and earn. We do scholarship programs, all pieces that try to not just make this a lecture to students, but do it in a way that they have that hands-on ability to understand what it is that we offer, whether it's a younger person or somebody starting off, whether it's a future customer relationship, or another key piece for us is a future employee. Because again, when you don't have a large incoming new influx population, your future employees are going to be those current students. And so how do we develop those relationships in the future? It's by doing it now.
Thank you. Bruce.
I started my career as a CPA, so I'm kind of a numbers guy, and I think in our business, being publicly held, we owe a return to our shareholders. And we have consistently, our growth rates have far exceeded our earnings rate, and so later this year we're looking at an additional capital infusion for the bank. So we've been planning for this for about a year. And coincidentally, almost exactly a year ago, the Federal Reserve Bank changed their holding company rules. It was Regulation A+, which moved a lot of the thresholds up to $1 billion. And so we're currently in the process of forming a holding company, and the express purpose of that, at least one of them, is to use debt as a way to manage the capital level at the bank going forward. It's pretty cheap money. One of the benefits of a low interest rate environment, obviously, is you can borrow money cheap. And so we're seeing at least offers of debt at the holding company level anywhere from 4.5% to 6.5% pre-tax, which is a fairly inexpensive form of capital. Conversely, if you're doing a capital raise, we think probably a $10 million block is about a minimum level we could raise in one offering. Not only do you have the cost of the offering, but we have about $50 million in capital, so you've got an immediate 20% dilution to your shareholders on a return basis. And we can manage that in smaller increments at a cheaper cost, we believe, through debt. And projecting our numbers out to $1 billion, we don't see debt becoming more than 15 to 20% of our total capital structure, and we think that's a very healthy ratio. Secondary potential benefit, and I'll take a different solution or a different path than what David mentioned. Liquidity in the stock, I think, is a problem for every community bank. Certainly one for us. And we have those shareholders who love what we're doing. They realize that it's a long-term hold, but as Dave mentioned, circumstances happen, so you have people who want to sell stock. And so they have 500 shares, and it lingers out there, and somebody will lowball the price, and the stock goes down a quarter, and 2 months later goes down another quarter, and all of a sudden you can't figure out why your stock's trading at the price that it is. Well, we think with a bank holding company, we at least have the flexibility of offering a stock buyback program, and we can set those prices at wherever we deem appropriate and substitute debt for any stock repurchases. Based on our internal projections, I'm fairly confident we can increase our ROE by 10 to 20% over the next 3 years by using the debt avenue versus a capital raise. So we're excited about that. I'm a flexibility guy. I like to have options in solving, especially capital management issues. And we don't see a huge downside. The cost of formation is fairly inexpensive. You do have the possibility of adding an additional regulator, but if you just have a shell holding company, most of those exams are done off-site and fairly inexpensive.
Thank you. Alden.
We were asked to sort of give some examples about looking forward in the forward trends of banking and the economy itself. And in my previous remarks, I mentioned that things were changing and we had to begin looking at doing things different for a number of different reasons. And we talked about the different delivery channels that are before us, but we also have not only the different channels before us, but we have new competition coming into the marketplace. And that new competition is sort of unknown at this particular point, but it is approaching us fast and furious. As I mentioned, I continue to give you the theme that we consistently look in the marketplace for banking opportunities that the larger and the regional banks don't want to engage in. And we still today continue to do that 43 years later. It has worked for us. Our bank has been in business 43 years, 44 years this year. We've been profitable every year with the exception of 5 years in the business. So our business model has worked for us. But there are a couple of things that we have began to change within our institution. We do know for a fact that fewer and fewer people are coming into the bank to conduct their banking business. So one thing we have began doing is looking at our banking facilities and downsizing our banking facilities. We are about to open a new facility within the next couple of weeks, and that new facility has 1,800 square feet, 2 telestations. So we have driven a lot of our customers to the technology side of banking, and we basically encourage them to bank from their home, bank from their office, and things of that nature. So the delivery channels and also the way people are using financial institutions today is changing very rapidly. We had to change our behavior in our institution, and we had to begin changing all of our employees to become sales-oriented, which is a very, very difficult thing to do. So we have developed sales teams in all of our markets and began looking at, now, how do we do this thing going forward? This is the future. So I'm challenging you in the audience to look at how are you going to deliver your message. Digital marketing is one space that we have been working with for some time. We don't have it down yet, but we're getting there. And we think the only way we're going to be able to compete in the marketplace is through digital marketing. We can't afford the other typical and traditional types of marketing through the media space. So it's a direct link with the market niche that we want to do business with. So we're going to be very, very heavy in digital marketing. Not only the digital marketing, but to emphasize to our sales team. And really, we've identified a niche for small business. There's a niche of small business owners out there that are being left behind by the larger institutions. And it's very good business. And it's owner-occupied real estate. And to lend to those individuals who own their building, want to expand, and want to buy new facilities, it's a great market niche that we're looking at. So along with the virtual banking that we're looking at, the new way of lending and receiving and creating customers. And we also see the small and medium-sized business loan program an opportunity with bank consolidation, because bank consolidation is taking place, and a lot of small businesses are really looking for a new home. So we see all of this as opportunity. And one thing that we have practiced in our institution is whenever we see an obstacle, that O for obstacle also means opportunity.
Thank you. Scott?
When I listened to the forward-looking comments, I was struck by the theme of technology. It reminded me of my students then that the iPhone or smartphone is attached to their hand 90% of the time. They're a different generation, obviously, and I think one thing that I have a concern about going forward, community banks, as I emphasized, do relationship banking, which exploits soft information, which I think is gathered face-to-face many times. I'm not sure how that's going to translate in a new environment where technology is the communication vehicle. I think community bankers need to think about this changing world. It's going to be a challenge for us, I believe. Although I think we will still be able to communicate, but it seems like these are not natural combinations of face-to-face communication and using technology to communicate. Millennials use technology to communicate, and I think we need to recognize that and work with that, but I have faith that we will be able to do that and face that challenge. The other challenge that hasn't been mentioned, I think going forward and looking forward, that I see in West Texas in particular, is the urbanization that is going on and moving out of rural communities. I think that's part of something that's very common in West Texas. I live in Lubbock, and a lot of those rural communities, those individuals are moving to Lubbock then, and part of the urbanization that is going on. And this is going to influence community banks in many of these locations then, as their communities are shrinking then. So when we count community banks, then I think we need to recognize that there's maybe a force going on there, this urbanization that we're observing in our economy broadly, and that's going to be a challenge for community banks to deal with, and we need to recognize there are people still there that need to be served and deal with that.
Thank you for sharing both your past and prospective challenges and the strategies you've utilized to ensure your long-term success. I think there's some really good lessons learned in your comments for all of us. And before we entertain questions from the audience, let's wrap up with a few comments on best practices you utilize to manage risks. So, Dave, if you could lead us off again.
I think we community bankers have been dealt a great hand. The chairman recounted the stats on the declining number of us, and while I think that's bad public policy for our country, I have to admit, competitively, I like having fewer competitors in this business, and I think if I stay true to what I'm best at, that is providing flexible, friendly service to my depositors and providing access to decision makers for small and medium-sized businesses, that's something the big banks can't beat me at. They can outspend me on technology. They can have more branches than me. They can have broader product offerings, but they can't do that well. And I think the best risk management practice I can have is to stay true to what I am and not worry so much about what the big banks are doing, and to play the really good hand that I've been dealt, to play that hand well. There's also a lot of talk about the need to get to a certain dollar size, and this false dilemma is preached of having to either acquire or be acquired. I was recently in the company of Lee Burrows, an investment banker with Banks Street Partners, and with remarkable candor for an investment banker, he said to me the following: why would you buy somebody else at 1.5 times book when you can buy yourself at book? This is in the context of our stock repurchase discussion. I think if we simply manage our organization to our strengths, we've got a great future.
Thank you. Rebecca.
You know, as I think about risk management, we have so many different tools and reports and pieces that we've implemented in our organizations these days. The thought that came to mind for me is a culture around risk management, and that's where we've really focused within our organization these days is how do we approach the gray area? A lot of what we do in some cases is black and white, and we have procedures and we have policies and, you know, checklists maybe sometimes that help us work through that. But as we create a customer experience, as we tackle loan decisions, as we work through a difficult situation, how are we as an organization developing this thought process around risk and critical thinking to understand how we evaluate those decisions that we make as potentially they become more complex, as we deal with more gray area, because that really, for us, is where the opportunity is the pieces that aren't so clear. And so within our organization, we're doing things within our committee structure where we're bringing in more individuals that aren't necessarily myself or our bank president, but folks that are hands-on thinking about their day-to-day operations, processes as we write policy, processes as we do risk assessments that really make folks think not just what the problem or solution is, but what's the risk, how are we going to mitigate it, and how are we comfortable making that decision moving forward. And so that's been a fun cultural shift within our organization that really has helped to empower what I hope to be continued strong leadership development, as well as thinking outside the box in terms of how we take care of our customers and our community.
Thank you. Bruce.
Well, we can't control interest rates. We can't control the economy. We can't control regulatory compliance rules coming down the pike. But there are knobs that we can control within our organizations. And we spend at our bank time focusing on what those knobs are, and we keep our hands on them all the time. And it begins with people. This is still a people business. We focus on hiring best of breed. And there's no substitute for having great people in your organization. Our hiring process, as an example, goes through at least 6 interviews before we will bring a new person on board. We're very, very diligent in our hiring practices, and has proved to be our greatest asset. You can control underwriting. You can control the cost of your organization. And we spend a lot of time focusing on those things, and we think that it's a great future for community banking. Pay attention to the basics and do them very, very well.
Scott mentioned something that made me sort of remember some of the things that we're doing to make certain that the younger people with the machines in their hand are real people. One thing that's very, very important, and it's a management practice for us as well, and sort of mitigating risk. We are very, very, very involved in the community. And when I say very involved in the community, I mean we have practically all of our offices in some type of community activity. And sometimes they're out of the bank more than they're in the bank dealing with community activity. But that's the people-to-people pieces that we have in conjunction with our technology play. One key that I'd like to share with you, I think I only have one person in here from my market place, that we see as a way of keeping in touch with this new generation as well as with our customer base. We have focused on home ownership in a lot of different ways, and you have an opportunity to deal with these individuals on a very regular basis, trust me. And that's how you stay in touch with the people, but you have them to use your technology in order to deliver the services. So I want you to keep in mind that your people-to-people piece is very much part of where we have to go in the future. And as what was mentioned, I mean, that's a delivery channel, number one, and number two, that is the best way for you to get even additional business. I mentioned earlier that we have high volume, low balance. So we had to find different ways of mitigating risk in a number of different areas. Our customer base we lend to has very low, in most places, credit scores. I think really about maybe 20% of our customers would have credit scores above 700. So what we've established in our lending practice, we have centralized underwriting to begin with, and we have centralized collections. And as a result of that, we also have a couple of committees that review reports on a very, very regular basis. And our collection department supplies top management with a trend in 0 to 15 days, 15 days to 29 days, et cetera. And we can tell from an early warning signal that we receive through these reports what is about to go bad, and we jump on it very, very early, both for the small business as well as the consumer, to help mitigate whatever those challenges are. So the monitoring of all areas of our bank is a very strong suit for us, and we train all of our management team to monitor, and we develop dashboards for every area of the bank. So we monitor the dashboards on a monthly basis, and everyone is tied to the goals and objectives. So the monitoring piece for mitigating risk in our bank is very important. The second thing that we do, we developed years ago a budget modeling tool that we've used probably over the last 30 years, and we call it the one-day look. We could literally, it's a one-page report. We can literally take all of our crew numbers, for the most part, and predict where we're going to end up for the month, for the quarter, or for the year. And the reason that's important to us is because we're monitoring the risk factors that we have, and any changes in the marketplace will show up in this monitoring tool that we have. So two basic things that we use. We're very, very much on top of the budgeting process and the monitoring of the budget process, and the monitoring of the budget on a monthly basis. And then the second piece, of course, I mentioned that we manage risk by having just a ton of different management reports that we look at that tell us the stories before it becomes a fire. So again, thank you very much.
Thank you, Alden. Scott, how about from an academic perspective?
I learn from talking to community bankers a great deal myself. As an academician teaching banking courses, I'm struck by the fact that in talking about risk management, we break that discussion into different components. We'll talk about credit risk and how you measure that and how you manage that. And we talk about interest rate risk ad nauseum, according to my students, and how you measure that and how you manage that. But in talking to community bankers, I'm struck by the recognition that these risks aren't in individual silos, and that we need to recognize some of these risks are interrelated. And so I hear this notion of enterprise risk management then. And I think community bankers actually have a much better handle on their enterprise than the real big banks then. Could you imagine trying to manage Bank of America with all of the various parcels and parts? Talk about the risk that that's exposed to. I think we have a fairly simple task then in comparison. But I do think it gives us a strength then for the community banker. It is technology, the risk of technology, its interest rate risk, its credit risk. We need to look at all of the various components and recognize that they aren't separate and they're intertwined. They can influence one another. And I think this move that I see many community bankers, and most, I would say, do it just by intuition in managing the bank. But it is a strength that we have in this business model that community banks have, looking at risk from a global perspective instead of trying to measure individual components.
Thank you. I appreciate all of those best practices. Why don't we stop here and provide the audience with an opportunity to ask the panel questions. If you have a question, I'd encourage you to go to the mic, which is in the middle of the room. Any questions?
Don't give me a microphone, though. Never met one I didn't like. Just kind of curious as to what kind of loan deposit ratios you're running on your banks and how that has grown or shrunk over the last maybe 4 or 5 years, and where you see that maybe going over the next 4 or 5 years in your strategies you've kind of discussed.
75%. It's been very steady at that number. Love it to be higher. I'm not sure it's going to be.
We've declined over the last 5 years from 70, 75. Right now we're at about 50. It's a huge challenge facing us. And so a lot of what we're continuing to do is think about those buckets that maybe we hadn't been active in and what we're doing to promote some of the loan products that we're doing and getting that message out there. But we've been fortunate to have great core deposit growth. We are just local market is not keeping up with that demand.
Well, I agree with Rebecca. It's been a marathon to try to get a balance. 4 or 5 years ago, we were 30% loan deposit ratio, and that makes earnings a little tough. Right now, we're around 70. We think 70, 75% is a pretty good sweet spot for us.
We're in the same ballpark, between 70, 74%. We don't see our loan to deposit ratio getting much more than that. We're looking at bumping it up just a little, but the credits in the marketplace right now is a little challenging, so we're trying to be a little careful.
Thank you. Next.
Stuck. My name is Mike Bush. I'm the president and CEO of Mississippi River Bank, and I'm the guy Alden was talking about who's in his market share. He didn't want to give me that secret. However, my business model for our bank is more in line with what David and Bruce do, and that's commercial C&I and commercial real estate lending. And the problem, how many people in this room, is that the kind of their business model, C&I? Are all of y'all aware of the new FDIC insurance premium program that's going to go in place, and that there's going to be a look back for premiums based upon where you have your loans, regardless of how your loans are performing? Do y'all know that? If you don't, we need to know, and the ABA has taken a position. We've asked the FDIC, and I don't know if we're still in the comment period or not, but if we are, I think it's very important that, we be rated just on what we're doing with our banks and our camel rating. And for us as an industry to be penalized by a look back of what happened between 2008 and now and say that we have to pay additional premiums, I think that will be a curtailment on our ability to be lenders in what we do and keep making that 44% of the loans for small business. So I hope everybody's aware of that. If you're not, you need to have a position. And I don't know if y'all were aware of it. And if you have a position, either David or Bruce.
Is there any asset size that invokes
Everybody
that?
10 billion or less. This is going to be under the new deal under Dodd-Frank. Every bank 10 billion or less will be in that category.
I can't recite chapter and verse on that new proposed rule. What I can tell you is that I'm very much looking forward to my premiums going down by about 30% in the third or fourth quarter of this year. And while I'm not a big fan of the Dodd-Frank Act, I will tell you, I'm grateful that the assessment base was changed to be total liabilities, not just deposits. That favors guys like me. I'm also grateful that the cost to get the diff from 115 to 135 is on the backs of the big banks. And so I will stay attuned to what this gentleman is talking about, but I think we're going to get a nice reduction in premium within the next couple of quarters.
Are there any other questions?
Hi, I'm Kathy Lemieux, and I'm from the Chicago Fed. You all mentioned technology, and certainly we read about the many different ways banks interface with some of these new fintech lenders. And so I would like to ask each of the panel members, do you consider these trends an opportunity or a threat?
I think it's some of both. When I heard, but mostly opportunity, when I heard that a certain big bank decided it's going to have all of its small business loans under $250,000 outsourced to a fintech company, I jumped and clicked my heels, because while there's a slice of the pie that's going to like that, there's a bigger slice of the pie that it's going to drive nuts. And they might as well say, go to your local community bank instead, because it's just not something that we can do. The small business owners that we lend to are invariably imperfect in some way. Maybe they got a strong debt coverage ratio, but not the capital position we'd like. Maybe they have good collateral, but not quite the credit history we'd like to see. What we specialize in is lending to the imperfect. And I don't think that's well served by the fintech space. I think it's opportunities for people like us.
I completely agree, and I think another opportunity is the actual technologies that are being used themselves, and how we as community banks can leverage some of those models to create that imperfect situation and ability to deliver and compete for all borrowers regardless of their scenarios. So I think that's a fun piece of it as well.
From what I read, Washington is starting to look at the fintech world and establish some regulatory boundaries, at least to level the playing field to some degree. If I had a concern as a community bank, most all of us use service bureaus, and so we're reliant on a single provider for a lot of our technology. And so we've been leaning on our provider and had a whole new series of conversations about what they're doing in terms of monitoring fintech development and partnerships that they might be able to embrace, which would then make it available to us.
We see it as a huge opportunity, and that's why we have entered the technology space, especially on the digital marketing. As what was mentioned earlier, these small businesses, once they go to these technology lenders, they're going to find out that the community bank is the best space for them to begin with. So using the technology and using the digital marketing will help drive them to us, because you can't just make a loan over the internet or through some technology piece. I mean, that will work for a little while, but most of the people in business, most of the consumers, they have certain types of issues that community banks specialize in. So we see it as an opportunity to drive business our way. And that is how we will open ourselves up to a greater marketplace. So we look at it as a real opportunity.
I would just add that I think it is mainly an opportunity, but there is a threat there. With tomorrow's small business borrower that is going to be more technology oriented, I think community banks need to make sure that they are still connecting with those individuals. So it is a threat from that perspective. On net, though, I would agree with the consensus that it's more of an opportunity, that the big banks are going to mess it up.
Thank you.
Are there any other questions? I think we have time for at least one more.
If I can end maybe with the last question or close to the last question. First, I want to thank the panelists. You know, as community bankers, we don't really like to share our ideas or our thoughts, and we definitely appreciate that. And since this is long-term strategies, what's your personnel long-term strategy for what keeps you up at night to say, how are we going to replace these people in the next 10 years? What part of your bank concerns you the most? And what have you thought about maybe an innovative strategy to replace those individuals in your bank? Because I know a number of you have said our success is our people that work for us. And how do we replace those and find that kind of talent over the next couple of years? So that's my question. Thank you.
It's a great question. We do have a talent crisis in our industry, partly because we have a big image problem, and also in part because there aren't the big bank training programs like there once were, that I was, one of the last to come through. Now, thankfully, I only have to hire 3 or 4 new people a year, so I don't have scores and scores that I've got to find. I am very pleased that we've been able to bring in some young college grads over the last 9 years of our existence that are smart and are hungry and care and want to do a good job. And today, my BSA officer is somebody who we hired as an intern. My credit department manager, who's a crackerjack kid, hired as an intern. We've had very good experience in carefully hiring young people and showing them there's a really good career path in commercial banking that they might not have known about. And I hope that we're able to continue to do that to grow the next ranks of leaders.
I'm facing a retirement of my compliance officer in the next 5 years amongst a few other positions within the organization, and that's one that does keep me up at night, just given this particular individual has been with the bank for 30 plus years. She's worked in all areas of the organization. You don't replace that kind of knowledge easily at all. And so for us, it's been building that through amongst several different individuals within our compliance committee. This last year, we've added, I want to say, 4 people to it, and trying to just pull those folks that are working in different areas of the organization and beefing up their compliance knowledge. They're now doing the compliance audits as opposed to the compliance officer, and really trying to get that hands-on experience. It's also a great way for me to sort of test out some of the different personalities and see who may be a best next fit. And, compliance is a perfect example of something, it's everybody's job, but there's so much information and so much knowledge. How do we get some of those specific technical skills spread out throughout the organization? I think another piece to this, and something that I take very personal, is thinking about our industry as a whole. Hasn't been that exciting, sexy career that people think about. And I think for me, that's something very important. I think about how we as an industry tell our story to get more folks as they're coming through college thinking, I want to be a community banker. I mean, it sounds silly, but I think part of the way we stem this tide is by getting people to talk about it and thinking beyond banking schools, because those folks are already in this career. So how do we back up a little bit younger and think about how we promote our industry for those future folks that bring the skills and talents back to their hometown or to another community and want to engage in what we get to do?
It's a great question. Probably you guys out there looking this way think we've got a bunch of young people up here on the panel, but looking out that way, not so much, not so much. It's a very legitimate question. We talk about it a lot at our bank. It's not only staff, it's our directors. Our executive team probably averages 65, 6 years old. Our directors probably average 67, 68 years old. So you roll the clock forward 5 years, 10 years, and there's going to be a wholesale replacement of some form that's got to take place. So we haven't solved it yet. I will say that some of these young kids coming out of school are very, very smart, and they know how to use technology to get a heck of a lot of work done. And there's some real diamonds in the rough out there. And so, you got to create a work environment that is conducive to what I don't know where their head's at, but if you can get them focused, they're quality people, they can do a good job for you. I think retaining them is probably the bigger challenge over the long haul, but but it is a problem.
We haven't found a solution for that one either, but we are constantly looking in the younger generation atmosphere. One thing that we started some 4 years ago, we developed a leadership training institute in order to sort of build leadership for the community. And we have classes between 20 and 25 individuals top. We've graduated 150 of those individuals, and we find that those individuals go out into the community and talk about what a great job we do at the bank. And as a result of that, we get a lot of people who are interested not only in our institution from the banking side, but also from the employment side. So that has been a very good blessing for us as well. It's been a good piece for the community. And the 150 graduates that came out of the Institute, they are presently on boards and commissions within the entire metropolitan area. So those individuals are sending business, they're sending employees, they have friends that want to relocate to New Orleans, and the first place they send them is to the bank. So we get to see a lot of resumes, and we pick and choose from those resumes.
Let me just on that encourage you to reach out if you are looking for new talent. Reach out to your local higher education institution. I would mention the Conference of State Bank Supervisors has started a very interesting program with regard to community banks, a case study, national competition where students then are encouraged to study a community bank. Last year they studied commercial real estate that a community bank was doing in their location. I was a judge on that competition, and there were 6 case studies that really showed these students reached out and learned a great deal about community banks and the commercial real estate exposure and the problems that surfaced during the financial crisis. This year, the case studies built around small business lending, and I decided to form a team that is studying small business lending from a local community bank. And I think I heard there are 30 teams this year that are organized. So hopefully this will be a growing thing that will get the next generation understanding what community banks do in very different ways firsthand.
Let me just add to that. You have a lot of young, bright people going to work for these large institutions, and they're finding out that they don't want to be associated with a large organization. So we raid that talent pool as well. And normally they come with some good training. So that's been a very good source for us.
So thank you, the audience, for those questions. Before we conclude, please join me in thanking our panel for sharing. They did a tremendous job, I think, this morning, sharing their experiences, some of their best practices, and importantly, their strategies. And I also want to just thank you for serving your communities. You do a great job. Thank you. We're going to take a short break right now. I would just ask if you would please return to your seats in 15 minutes. Thank you.
Good comment. Thank you. I enjoyed it. Nice panel.